Hi everyone, I'm Oldfish. Welcome to my channel. In Canada, bank stocks and the broader financial sector have long been dividend investors' favorites. The core reason is simple: steady cash flow and predictable dividends. If, on top of this stable dividend base, you layer a covered call strategy, you can squeeze out even more cash flow. Then, a financial sector plus covered call cash flow powerhouse is really worth a closer look. So today, I'll share an ETF I personally like a lot, a high-yield Canadian financials ETF. It's BANK.TO from Evolve. First, some market context. In Canada's SP/TSX Composite Index, financials have long been about one-third. You could say financials have always been a key sector in Canada. Financials plus energy, these two major sectors, often make up nearly half of the market. So when you invest in BANK.TO, a product that's 100% Canadian financials, you can think of it as placing your bets on half of Canada's market foundation. Let's quickly introduce this ETF. Its full name is Evolve Canadian Banks and Lifecos Enhanced Yield Index Fund. It does three main things. First, it tracks a Canadian financials index, bundling the big six banks and leading insurers into an equal weight basket. Second, at the portfolio level, it sells out of the money calls on up to 33% of holdings to collect option premium. Third, it maintains modest 1.25x light leverage to boost the distribution level and income. Over the past 12 months, its average annualized yield has been around 15%, with monthly distributions. Now, let's look at BANK.TO's performance. According to Evolve's website, year-to-date in 2025, including distributions, Bank's return has reached 12.66%. And its past one-year total return is about 21.03%. Since inception, its total return has reached 24.29%. Over the past 12 months, its annualized distribution yield has been 14.7%. The most recent monthly payout was 11 cents per share. So we can see, Bank has performed quite well over the past year, which ties in with 2025's strong performance from Canada's financial sector. They're closely related. At this point, you might ask, Bank's 15% annualized yield, where does it come from? Let's break it down. How exactly does Bank generate its distributions? Let's compare with other similar NAV-preserving covered call ETFs, such as HDIV and USCL. Their yields are around 11%, 12%. But Bank's yield can reach nearly 15%. Which brings us to Bank structure and its covered call approach. The overall design is excellent, and that's the biggest reason I like it. So where exactly does Bank's smart structure show? First, the holdings. Its portfolio tracks a Canadian financials index, Solactive Canadian Core Financials Equal Weight Index. What's the benefit of tracking an index? It means the constituents adjust dynamically with the index, creating a survival of the fittest mechanism. Within the index, you've got Canada's leading banks and top insurers. These companies themselves typically yield about 3%, 5% in annual dividends, which lifts Bank's distribution level. In other words, within that 15% yield, a large portion comes from dividends. Second, the covered call execution is strong. The covered call overwrite ratio is relatively low, capped at only 33% of the overall portfolio. They sell out of the money calls, OTM, which converts some potential upside into certain income. Lower coverage means you retain more upside potential. With coverage capped at 33%, you can loosely think of it as keeping about 66% of the upside. So when Bank is in a bull market, beyond the distributions, there's still decent room for gains. Also, Evolve's covered call strategy is implemented stock by stock within the holdings, writing calls individually based on each name's volatility. It's more work, but it's the most efficient approach. That's why, even though Bank's covered call strategy only covers a portion of the portfolio, up to just 33%, it still generates substantial income. Lastly, Bank uses light leverage of about 1.25x. While covered calls reduce volatility, they can also cause long-term returns to lag the underlying assets. With 1.25x leverage, you can scale back some of that dampening to negatives, making a positive. So Bank can deliver performance closer to the underlying assets while still paying roughly 15% cash flow. So how good is this structure? Let's do a simple comparison. Besides Bank, I couldn't find an ETF tracking the exact same index. So I'll compare it with BMOZEB against Bank. ZEB is an equal weight ETF of Canada's big six banks. Though it lacks positions in certain insurers, but a large portion of its underlying holdings overlaps with Bank. Both are ETFs within Canada's financial sector. The difference is ZEB doesn't use a covered call strategy that caps upside, and it has no leverage. It's a traditional dividend ETF. Let's compare them. A 3-year comparison of ZEB versus Bank. We can see ZEB is far ahead of Bank in price performance. Over the past 3 years, ZEB's price is up 53.46%, while Bank is up 20.37%. That's because ZEB doesn't limit upside with a covered call overlay, so its price appreciation significantly outpaced Bank's. Of course, that's only a price comparison and doesn't include distributions. When we switch to total return, meaning returns including distributions, we see Bank's 3-year total return reached 79.96% versus 73.15% for ZEB. We can see Bank's total return leads ZEB's. As you can see, although Bank's covered call strategy caps some price upside, it converts that potential into higher distributions, and with 1.25x leverage in total return terms, it's not inferior to a traditional dividend ETF, while still delivering roughly 15% annualized monthly cash flow. Canada's financial sector has long had solid upside potential. Bank tracks Canada's Financials Index, benefiting from a survival of the fittest mechanism. With a sensible covered call approach, it can effectively mitigate NAV drawdowns, and with 1.25x leverage. In terms of performance, it doesn't lag investing directly in traditional dividend ETFs for Canadian financials. If there's a drawback, it's the relatively high management fee, about 0.6%, plus borrowing costs for the 1.25x leverage and trading expenses. Total operating costs in 2024 easily topped 1%. Overall, I think Bank is a solid cash flow product. I personally invest in this ETF too. What do you think? Share your thoughts below. Thanks for watching to the end. Video production isn't easy. Please like, comment, and subscribe. Thank you, everyone.